Picture this. You're sitting at your kitchen table in Ohio on a Sunday night, wondering why your balance never seems to grow. You're working full-time, you're paying your bills, you're doing everything you were told to do, yet somehow, getting ahead feels like it's meant for someone else. Here's the truth nobody ever sat down and explained to you. The reason so many Americans feel financially stuck isn't because they're lazy, and it isn't because they're unlucky. It's because nobody ever taught them the basic rules of money. And today, we're going to change that. There are a handful of financial concepts that completely change the way you think about money once you truly understand them. Not investment tricks, not get-rich-quick schemes, the actual fundamentals. The lessons that should have been taught in every high school classroom, but never were. Once these ideas click, the way you make financial decisions changes forever. Let's start with the concept that causes more financial damage than almost anything else: compound interest. Most people have heard the term, but very few actually understand its power until it's too late. Here's the simplest explanation. When you invest money and earn a return, that return begins earning returns of its own. Your money starts making money, and then that new money starts making money too. The growth builds on itself. A $10,000 investment earning an average annual return of 8% doesn't simply earn $800 every year forever. Over time, those gains compound. By year 10, it's growing by more than $1,600 per year. By year 20, more than $3,300 per year. Every year, your money does more work than the year before without requiring any additional effort from you. But here's the part that really hurts. Compound interest works exactly the same way in reverse. Credit card debt with a 22% interest rate isn't just expensive, it's accelerating. A $5,000 balance that isn't paid off doesn't stay the same. It grows, and every month it grows faster than the month before. People who understand compound interest use it to build wealth. People who don't often spend years building wealth for the banks instead. Now let's talk about the concept that separates people who eventually achieve financial freedom from those who stay stuck for decades. The difference between assets and liabilities. An asset puts money into your pocket. A liability takes money out of your pocket. That's the entire idea. Simple. But applying it correctly is where most people struggle, because the American financial system has spent decades convincing people that liabilities are actually assets. Your car is not an asset. The moment you drive it off the dealership lot, it begins losing value while continuing to cost you money through insurance, gas, repairs, and maintenance. For many families, a primary residence behaves more like a liability than a true income-producing asset. Real wealth is built by owning things that either generate income or appreciate in value without constantly draining your cash flow. Stocks, rental properties, businesses, royalties, intellectual property. These are assets. The fastest way to build wealth is by consistently directing your money toward things that make you more money instead of confusing expensive purchases with financial success. Now, here's another concept that can completely change the way you think about your career and your future: active income versus passive income. Active income is money you earn by working. If you stop working, the income stops too. Salaries, hourly wages, commissions, and freelance work all fall into this category. Passive income is different. It's money that continues to arrive whether you're working or not. Dividends from stocks, rental income, royalties, returns from index fund investments. The ultimate goal of personal finance isn't simply to earn more active income, it's to transform part of your active income into assets that generate passive income. That's how people eventually stop trading time for money. And in America, the tax system actually encourages this approach. Long-term capital gains and qualified dividends are generally taxed at lower rates than ordinary earned income, rewarding people who own productive assets rather than relying entirely on wages. Now let's talk about something many people ignore because it feels invisible: inflation. Every dollar sitting idle is slowly losing purchasing power. Not overnight, not dramatically, but steadily. If inflation averages 3% per year, something that costs $100 today will cost about $134 10 years from now, and roughly $180 20 years from now. That savings account earning 0.5% interest isn't really protecting your money, it's simply reducing the speed at which your purchasing power disappears. This is why holding excessive amounts of cash for long periods can quietly become a costly financial decision. The best long-term defense against inflation is ownership. Owning businesses through stocks, owning productive real estate, or owning investments that historically grow faster than inflation itself. Historically, the U.S. stock market has produced average annual returns of roughly 10% before inflation over long periods. That's why millions of ordinary Americans have built substantial wealth simply by investing consistently and staying invested through market ups and downs.